would retirement be like if you didn't have to make a monthly loan payment? Well, here to talk with me about this is Don Graves. Don is the president of the Housing Wealth Institute, the author of 3 books on reverse mortgages, and an adjunct instructor at the American College of Financial Services. Don, welcome.
Thanks, Bob. Good to be here.
It's good to have you here, and it will be good to have you walk us through what you regard as the top 10 debt management strategies for baby boomers. Where to start?
Sure. And I'm doing a series of articles with you all about the modern reverse mortgage. And this is the second installment. And this is the low-hanging fruit. One of the questions that many people ask, or I ask when I deal with advisors is, or clients, what would retirement look like or be like if you didn't have to make a monthly loan payment? Or sometimes I'll phrase it like this. I'll say, Mr. and Mrs. Jones, I see that you have a monthly mortgage payment, as do I. I'm curious, if you had a choice, would you rather that payment be mandatory or voluntary? What would you choose? And that sets the basis for an expanded conversation of debt management in retirement.
So it's important to note, too, I think, Don, the growing debt burden that people face. So this is not an insignificant problem when you pose that question.
No, depending on where you look, the number of baby boomers, particularly the younger baby boomers coming into retirement, carrying a mortgage, a second mortgage, a home equity loan, or a home equity line of credit, one of those 4, that's a large number. 68% in some cases. And I write in the article that the last gathering I went to, and I asked people, do you have a mortgage or home equity loan who were of age? That was 70, 80, 90%. So I think it's fair to say that the majority of people coming into retirement have some sort of loan against their home. So what do we do now that we typically will cease working and live off the things that we saved and, of course, Social Security? How do we handle that?
So I trust the answer might be reverse mortgage, but for many folks, it's a head scratcher. They don't know what a reverse mortgage is.
Sure. So a reverse mortgage is a federally insured loan, typically for those age 62 or better, that allows them to convert a portion of their home's value and turn it into tax-free dollars without giving up ownership, coming off title, or having to make monthly mortgage payments. Now, I remind people, the first reverse mortgage started in the United States in 1961, came under the control of the federal government in 1988. That's 36 years ago. So, folks, it's not new, it's not dangerous, it's not spooky. What is it? It's 4 letters, IJAM. It's just a mortgage. It's just a mortgage. But we've got some mythologies out there, and we've got some outdated information. And Bob, that's why I'm glad you're allowing me to write the series there, that once people begin to understand what the modern reverse mortgage is designed to do, which is 5 things: increase your cash flow, reduce your risks, preserve assets, improve liquidity, or add new dollars back to your retirement savings. Once we understand that those 5 things are very important, and anybody would want to know them. So that's the reverse mortgage. And the bank doesn't take the house, you don't lose the home, the kids don't lose the home. All of those former concepts, certainly you can read about it in the article or the things I've written.
Right. So is it worth taking us through a simple case study that illustrates how these work?
Sure. Let's look at what we'll call them Pierce and Linda. And they're coming into retirement. They're going to retire at the end of the year. They've got a home that's $650,000. And they've got a mortgage on their property of $200,000. Again, not uncommon. So every month, because they got it at 55, now they're 65. So they're paying over $1,700 a month principal and interest for that mortgage. They've got total retirement savings of $650,000, exactly what their home is worth. And they desire to spend $45,000 a year from that nest egg initially. Now, that's pretty aggressive, and around 7% initial withdrawal rate. Now, some gurus will say that's not enough, but most people will say that's a little bit aggressive. So now, what do you do if your advisor says, I think you should be spending closer to $25,000 versus $45,000, and that makes you sad? Well, now, remember, they're paying $1,700 a month principal and interest on the mortgage. What can they do? We can do a reverse mortgage. A reverse mortgage is going to make money available to them based off of 3 things. I'll draw a little triangle here. Age of the youngest spouse, value of the home, future projected interest rate, what the government calls the expected interest rate. Now, those three things tell us that they have a reverse mortgage benefit amount of around $224,000. That would be in the middle of the triangle, folks. Underneath the base of the triangle, we're going to pay off any loans, mortgages against the property. So the first thing the reverse mortgage does is pay off the $200,000 loan balance they have. When that happens, a lot of things come to fruition. First of all, we free up the payment, $1,750 a month. That's now freed up, and we've got a line of credit of $24,000. But for the purposes of the day, let's just focus on we got rid of this $1,750 a month payment. And so the article that this is referencing talks about 10 benefits to eliminating a monthly mortgage payment. I don't know if we want to go through all 10 because you can read it.
Let's go through as many as we can, Don, because I think it's well worth people understanding the benefits of eliminating this debt.
So the first one for Pierce and Linda, remember their goal was we desire $45,000 a month per year initial withdrawal rate, but their advisor said no, we think $25,000 is better. So the first benefit, when you get rid of this monthly mortgage payment, principal and interest of $1,750. It was one of my mentors and a friend of ours, Ed Slott, once asked me this question. He said, Don, if you get rid of a payment of $1,750, how much are you saving the client? And I thought, man, this guy's supposed to be pretty smart. I figured he would know that. And I said, well, $1,750. And he said, no. He said, because those dollars, in this case, are coming out from a qualified fund, a taxable fund. So it may take $2,200 to net the $1,750. And so if you're saving $2,250 pre-tax, multiply that by 12, that's $27,000 per year that's now staying in the portfolio. What does that mean? That means you're drawing out less and you can extend the life of your portfolio, typically another 10 to 14 years. That's a huge benefit. Number two, well, Don, if I'm no longer needing to draw out $27 pre-tax and netting this much to pay my mortgage, you're saying I'm reducing my taxes. Absolutely. You reduce your income tax by $27,000. That's reducing your provisional income if you're taking Social Security. That may certainly get you to a lower tax bracket. You may avoid some IRMA taxation. So there's benefit because you're reducing your income taxes. Number three, and this really goes to Pierce and Linda, bridging the gap. You'll recall they wanted $45,000. Their advisor thought, man, that is way too aggressive. But when we eliminated the monthly mortgage payment of $1,750, Pierce and Linda, in essence, can have their cake and eat it too. So they're able to spend more and enjoy the retirement that they believe they had without impacting their nest egg because we've eliminated a monthly mortgage payment. So I call those the big three. The rest of them are just things that people maybe have never thought of, that if I eliminated a monthly mortgage payment in retirement, what could I do? Support your grandchildren's education. That's one. Now you got $1,700 a month freed up. That's I support my grandchildren go to a private elementary school, and so I'm able to support that. And so there's a lot of needs. So grandparents, you can support your grandchildren's education. You can fund a life insurance policy for your children or grandchildren. What a wonderful gift to say, I'm going to purchase a life insurance policy for each of my children or grandchildren. I'm going to fund it because I've got this $1,750, this mortgage payment I'm no longer paying. I can do that. Number 6 here, I have an enhanced lifestyle to cover healthcare costs. That's certainly getting expensive in retirement, and so we can do that. Delay Social Security benefits. Pierce and Linda are 65, and maybe it's more beneficial to delay the taking of Social Security, at least for one of them, until age 70, but they may feel, wait, I need the income, I need some money. By eliminating the monthly mortgage payment, we can we can fund the Social Security. 8, 9, and 10, protecting against insurance policy lapses. In 2020, when COVID hit, a huge number of people called their insurance carrier who had life insurance and they were long-term care insurance, and they were saying, "Can we do something? Life has shifted." Imagine having bulk long-term care insurance at 55 or 50, and your retirement didn't turn out like you thought it would, but you eliminated a monthly mortgage payment. Now you freed up $1,700 a month. That's one thing. Protection against insurance lapses. Create an emergency fund is number 9. Don, I'm just going to bank that money. I'm just going to bank that money over here. Fine. Lots of things come up in retirement. And number 10, increasing charitable giving. A lot of your listeners, viewers, have a charitable giving interest. And they say, "I wish I could do more." But by eliminating a mandatory monthly mortgage payment, MMMP, $1,700 a month for Pierce and Linda can now go to charitable giving interest. So those are just 10 things. But the big 3 and then the other 7, it's a powerful way to, if you can eliminate a monthly mortgage payment, it certainly can strengthen, enhance, and lengthen retirement satisfaction.
So, Don, just one quick question. A lot of folks sometimes think about reverse mortgage as their break glass option to pay for long-term care expenses, whether it's at-home health aides or an assisted living facility or something else. You mentioned long-term care insurance, but in some cases people don't have such a policy. But this reverse mortgage becomes that policy in a way.
Well, sure, it certainly could, and I don't advocate using as a last resort. And because it's easier when you're proactive. There are certain types of reverse mortgage borrowers, and sometimes it is a last resort. Someone has died unexpectedly. Something has happened financially. But in these conversations, in the articles I'm writing, we're using it as a proactive tool. I've been doing this now. I'm coming into my 25th year. And in 25 years, I've had 16,000 plus consumer-facing conversations, and about 3,000 people went forward to become my clients. And that tells us 2 important things. Number 1, I've talked to a lot of people, Bob. I've heard a lot of stories.
I hope you're an extrovert, Don.
And number two, I know that the reverse mortgage is not an appropriate resource for every situation. So I tell folks, most of my clients did not need a reverse mortgage. I don't need to have my teeth cleaned. I don't need a physical. I don't need air conditioning. There's certain things I don't need. But once I discovered what it could do preventatively and proactively, I wanted it. And so there are typically 3 main buckets that retirees have in retirement. Their income bucket, Social Security, pension, if you're lucky, employment. Your investment bucket, IRAs, 401ks, these type of things. And number 3, your insurance bucket, fixed and variable annuities, whole and term life, disability, long-term care. So the question is, are those 3 buckets going to be enough to sustain you for what could be a retirement that's longer than expected, more expensive than predicted, and then certainly varied and non-predictable? Are those 3 buckets enough? Now, I would say, from 25 years of experience, or Mama would say, it's better to have resources and not need them than to need them and not have them. So what happens when we take what 87% of retirees have, that is a home, and we turn that into a growing, living financial tool to be incorporated with the other buckets? The reverse mortgage is the 4th bucket, and I would say because of the power of the line of credit, you want to set that up as soon as possible and take advantage of the compounding interest of that growing line of credit. So yes, it can be used as the break glass option. I think it's better to use it as an integrated approach, and then you can determine what bucket do I pull from first, my taxable, tax-deferred, tax-free, or my housing wealth bucket. And that makes a tremendous difference in retirement longevity.
Don, 2 more questions because it's an occupational hazard being a journalist. One is, a lot of people ask me, if I do a reverse mortgage, will I still be able to pass my house down to my children? And you mentioned at the outset that was the case, but I'm not sure if you have the time to walk us through actually how that would happen.
Sure. And the 4 letters I gave, it's just a mortgage. So let's go back to Pierce and Linda. So let's say they got a reverse mortgage. And remember, we paid off their existing mortgage. So just to keep it round numbers, they now have a loan balance of $200,000. And there'll be some finance closing costs. But we'll just say they owe me $200,000 and they have a $650,000 home. Now, the money they owe on a reverse mortgage, if you don't make a payment, that's going to grow. So the $200,000 loan balance is going to get bigger each year. So let's go out, Bob, 20 years. And I'm going to make up a big number, frightening number. You started out with $200,000. The interest rates in America stayed high. And 20 years from now, you owe me $500,000. And people say, oh my gosh, look at that. And I said, all right, but let's remember the other side of the equation. They had a $650,000 home. The typical home in America since the Civil War will double in value every 20 years. So now, 20 years later, your 650 home is worth 1.3 million, and I find that fairly conservative. So you die or you move. The children say, Mom and Daddy have a $1.3 million home. They have a $500,000 reverse mortgage loan balance. What typically happens? 98% of the children sell the house. 1.3 million pays off 500,000, and what's left over, Bob Powell? Is that 800,000? I think so. I'm from Kentucky. It's got to have a lot of zeros for me to get it quickly. So you see what happened there? 100% of the remaining equity passed on to the heirs or the estate or the client if they moved at that age. Well, wait a minute, Don. Wait a minute. That's fuzzy math from Kentucky. What happens if Mom and Dad owed 500,000, but the house depreciated and it's only worth 400,000? Now they owe you more than this is worth. What happens then? Thank you. And that's the difference between the reverse mortgage of 1961 and the federally insured reverse mortgage of 1988. The one we currently have, it's a non-recourse loan. That means, should you owe more than the value of the home when the loan becomes due and payable, that the only recourse the lender has are the net proceeds from the sale of the house. They can't go after other assets. There's no deficiency judgment taken against the heirs or the estate. So I've given you like the 1965 Clint Eastwood movie, The Good, the Bad, and the Ugly. But in all cases, you are protected, the heirs and the estate.
So one last question is, oftentimes someone might go to an advisor, and for various reasons, the advisor can't talk about reverse mortgages, even though it may be appropriate. Their firm won't let them. Their compliance department won't let them. They're not licensed to be able to offer this, et cetera, et cetera. What's your thought about seeking advice and counsel and guidance from professionals about this? If this is you want to be able to, I think, use an advisor who has access to all the tools available, like you said earlier, and not someone who can only use half the tools in the toolbox.
Well, I don't want to get on my I have a dream soapbox and go full Martin Luther King here, but I, like you, Bob, would say you want an advisor who has access to be able to, you want a AAA advisor. What does that mean? The advisor that says, Mr. and Mrs. Flintstone, is it important to you that we use all your available assets when planning for retirement? Should anything be excluded? That the Census Bureau says that of the total wealth of the baby boomers, 68% of that is in their home. And so if you have an advisor, I would encourage you, you wouldn't want them to overlook 68% of what you could use for retirement. But let's say you do, and your advisor says, I can't talk about that, or I'm not allowed to talk about that. You can certainly, that's what I do, Bob, and if you want to put that, or you want to get education. I have a master class online. It's not a sales class, it's just education. You're welcome to go there and get 47 minutes of education. If you want to pursue it, fine. I tell folks, watch the first 7 minutes. And after 7 minutes, there's an exit ramp. You say, this is garbage. I don't want anything to do with that. Most people, hundreds, say, no, I'm going to watch it. But whatever you do, whether through me but make sure you get the education. I think it's critically important. You can't overlook that which is a large concentration of your retirement wealth and still expect to meet your retirement income goals. And I think, and Bob, you're doing a lot of work with different organizations where housing wealth is now coming up in the conversation. They're receiving training for that. That's critically important.
So I should note in the article you mentioned that you can stay connected with you at AskDonGraves.com. So if folks have questions about reverse mortgages or want to learn more about what you're doing and the books that you have written, they can go there.
Yes, sir. That's right.
Well, Don, we've covered a lot of ground. If there's anything that bears reemphasizing or that we haven't covered, now's your chance.
Can I give the link if they want to watch the master class, Bob? You can go to www.housingwealthmasterclass.com. Housingwealthmasterclass.com. That's 47 minutes. It's educational in nature. And it's just you and I talking and walking through, me and the consumer talking and just walking through the information. I encourage you to do that.
Well, Don, I'm so grateful for you sharing your knowledge and wisdom with us. It's much appreciated. Thank you.